I need to warn you about something that almost nobody in the financial media is talking about. Something that could wipe out trillions of dollars in wealth over the next 24 to 36 months. Something that is going to blindside millions of investors who think they are safely diversified. The private equity bubble is starting to crack. And when it fully breaks, it is going to make the 2008 financial crisis look like a warm-up. I have spent over 40 years in banking. I have seen every financial crisis of the modern era up close. I have watched bubbles inflate and pop. I have seen how excessive leverage and unrealistic valuations eventually meet reality. And I am telling you right now, what has been building in private equity over the past 15 years is one of the most dangerous bubbles in financial history. The scary part is that most people do not even know they are exposed. They think private equity is something only billionaires and institutions invest in. They have no idea that their pension fund, their retirement account, their insurance company, they are all stuffed to the gills with private equity exposure. When this thing unwinds, ordinary Americans are going to get hurt badly. Let me take you back to 2007. I was running a major financial institution, and I could see the cracks forming in the housing market. The data was there if you knew where to look. Delinquencies were rising, home prices were stalling. The quality of mortgage originations had deteriorated dramatically. But almost nobody wanted to hear it. I remember sitting in meetings with regulators, with other bank executives, with investors, trying to raise the alarm. The response was always the same. Housing prices never go down nationally. The models show this is safe. You are being too conservative. Then 2008 happened. Lehman Brothers collapsed. The entire financial system nearly went down. Trillions of dollars in wealth evaporated. Millions of people lost their homes. The economy fell into the worst recession since the Great Depression. The lesson I took from that experience is that bubbles can grow far larger and last far longer than rational analysis would suggest. But they always pop eventually, always, and the bigger they get, the more painful the reckoning. What I am seeing in private equity today has all the hallmarks of 2007 housing. Excessive leverage, unrealistic valuations, deteriorating quality, a collective willingness to ignore obvious warning signs because everyone is making too much money to ask hard questions. Today I am going to break down exactly what is happening in private equity, why it matters to you even if you think you have no exposure, and what you should do to protect yourself before the crash comes. I am going to cover 4 major warning signs that tell me this bubble is already starting to crack. Each one alone would be concerning together. They paint a picture of an industry heading toward a major reckoning. The second warning sign, which I am putting first because it is the most immediate threat, is the wall of debt maturities coming due over the next 3 years. Private equity firms finance their acquisitions primarily with debt. When they buy a company, they typically put up only 30 to 40% equity and borrow the rest. This leverage is what generates their outsized returns when things go well. It is also what destroys them when things go badly. During the years of zero interest rates from 2009 through 2021, private equity firms borrowed enormous amounts of money at incredibly low rates. They locked in 5- and 7-year terms, assuming they would either sell the companies or refinance the debt before it came due. Well, those chickens are coming home to roost. Over the next 3 years, approximately $1.5 trillion of private equity-backed debt is maturing, $1.5 trillion. And here's the problem. Interest rates are no longer zero. They are 5, 6, 7% depending on credit quality. Companies that were barely profitable at 3% interest rates are going to be deeply unprofitable at 7%. I have been looking at the numbers, and they are terrifying. Many private equity portfolio companies are already struggling to cover their interest payments. Their interest coverage ratios, which measure earnings relative to interest expense have deteriorated from healthy levels of 3 or 4 times down to barely 1 times or even below. When these companies try to refinance their maturing debt, they are going to face a brutal choice. Either accept much higher interest rates that will crush their profitability or default. Many will choose default. Many will have no choice. The defaults have already started in 2023 and 24. We saw a significant uptick in private equity portfolio company bankruptcies. Companies that were supposedly worth billions turned out to be worth nothing. But this is just the beginning. The real wave of maturities hits in 2026 and 2027. What most people do not understand is how interconnected this all is. When a private equity-backed company defaults, the losses do not just hit the private equity fund. They hit the banks that made the loans, they hit the collateralized loan obligations that packaged the debt. They hit the insurance companies and pension funds that bought the costs. The contagion spreads through the entire financial system. This is exactly what happened with subprime mortgages in 2008. The mortgages themselves were a relatively small part of the financial system, but they had been packaged and repackaged and leveraged so many times that when they went bad, the losses multiplied throughout the system. Private equity debt is the new subprime, and when it cracks, the ripple effects are going to be enormous. The first warning sign, which I am covering second because it underlies everything else, is the massive disconnect between private equity valuations and public market reality. Here is something that should alarm anyone paying attention. Over the past 2 years, public stocks are down significantly from their peaks. Some sectors have been absolutely crushed. Technology stocks fell 40, 50, 60% from their highs. Yet during this same period, private equity firms have marked their portfolios down by only a few percentage points. How is this possible? Are private equity-backed companies somehow immune to the economic forces affecting their public counterparts? Are they magically more valuable while similar public companies are worth half what they were? Of course not. The answer is that private equity valuations are largely fictional. They are set by the private equity firms themselves based on models and assumptions that conveniently support whatever value they want to show. This is called mark-to-model, or more cynically, mark-to-myth, instead of marking their assets to actual market prices. Private equity firms mark them based on theoretical models. And surprise, surprise, those models almost never show significant declines. Why do they do this? Because private equity firms get paid based on assets under management. If they mark their portfolios to realistic values, assets under management would shrink and fees would decline. They also get paid carried interest based on gains. If they mark portfolios down, those gains would disappear and the carry would evaporate. The incentives are completely misaligned. Private equity firms are paid to overstate values. And their investors, the pension funds and endowments and insurance companies, are complicit because they do not want to report losses either. I have been in meetings with institutional investors who privately admit their private equity portfolios are probably worth 30 to 40% less than stated, but they cannot mark them down because it would blow up their own financial statements. So everyone pretends this is a ticking time bomb. At some point, reality forces recognition. Either the companies get sold and actual prices are revealed, or the companies go bankrupt and values go to zero, or an external event forces a reckoning. That moment is coming. The third warning sign is the deterioration in deal quality over the past 5 years. When too much money chases too few good deals, the quality of deals deteriorates. This is a fundamental law of finance, and over the past decade, an unprecedented amount of capital has flowed into private equity. Trillions of dollars raised by funds competing for a limited universe of companies to acquire. The result has been predictable. Purchase price multiples have expanded dramatically. Private equity firms are paying 15, 18, 20 times EBITDA for companies that historically traded at 8 to 10 times. They are justifying these prices with aggressive assumptions about cost cutting and revenue growth that rarely materialize. Even worse, they have moved down market into smaller, lower quality companies because the good large companies are too expensive or too picked over. These smaller companies have less robust management, weaker competitive positions, and more vulnerability to economic downturns. I have reviewed hundreds of private equity deals over my career. The deals done in 2019, 2020, and 2021 are among the worst I have ever seen. Prices were astronomical. Leverage was extreme. The underlying businesses were often mediocre at best. Many of these deals were done with the assumption that interest rates would stay low forever. That was the explicit input in the models. Permanent zero interest rates. When rates rose, the models broke. But the deals were already done, the money was already spent. Now these firms are sitting on portfolios of overpriced, over-leveraged companies bought at the top of the market. They cannot sell because the prices they would receive would crystallize massive losses. They cannot refinance because rates are too high. So they hold on and pretend, hoping something changes. This is not investing. This is praying. The fourth warning sign is the liquidity crisis brewing in private equity funds themselves. Private equity investments are illiquid by design. When you invest in a private equity fund, your money is locked up for 7 to 10 years. You cannot get it back when you want. You get it back when the fund sells its investments and returns capital. For years, this illiquidity was not a problem because investors were patient and distributions were plentiful. Private equity firms were selling companies, returning cash to investors, and everyone was happy. That has changed dramatically. In 2022 and 2023, distributions from private equity funds collapsed. Firms could not sell their portfolio companies because the IPO market was closed, and strategic buyers were not willing to pay the inflated prices that private equity firms needed. So they held on, and the cash stopped flowing. Meanwhile, many institutional investors are over-allocated to private equity. Pension funds that targeted 15% allocations to private equity found themselves at 20 or 25% because their public market portfolios declined while their private portfolios, mark to myth, stayed flat. These investors need to rebalance. They need to reduce private equity exposure, but they cannot because the investments are illiquid. So they have stopped making new commitments. They are trying to sell their existing positions on the secondary market. But there are far more sellers than buyers, and prices on the secondary market are 30, 40, 50% below stated values. This is creating a doom loop. Private equity firms cannot raise new capital because investors are over-allocated and demanding liquidity. Without new capital, they cannot do new deals. Without new deals, they cannot demonstrate returns. Without returns, they cannot raise future funds. The virtuous cycle that powered private equity for 2 decades is turning vicious. Some of the largest private equity firms have seen their fundraising collapse by 50% or more compared to previous cycles. They are laying off staff, they are cutting costs, they are showing all the signs of an industry in distress. Now let me bring all of this together and explain why it matters to you personally. You might be thinking, I do not invest in private equity. This does not affect me. You are almost certainly wrong. If you have a pension, you are exposed to private equity. Public pension funds have between 15 and 30% of their assets in alternative investments, primarily private equity, teacher pensions, police pensions, government employee pensions, all stuffed with private equity. When private equity valuations crater, pension-funded status will plummet. Plans that are already underfunded will become critically underfunded. This will force painful choices, either dramatically increase contributions, which means higher taxes or lower wages, or cut benefits for retirees, or some combination of both. If you have insurance, you are exposed to private equity. Insurance companies have dramatically increased their private equity allocations over the past decade. When those investments decline, insurance companies will need to raise premiums or cut coverage to maintain their capital ratios. If you own a home in a community with a lot of private equity-backed businesses, you are exposed. When leveraged buyout companies fail, they lay off workers. Those workers stop spending. Local economies suffer. Home values decline. If you work for a private equity-backed company, you are directly exposed. More than 11 million Americans work for companies owned by private equity. When the debt comes due and the companies cannot pay, layoffs follow, plants close. Communities are devastated. The point is that private equity has become so large and so interconnected that its problems become everyone's problems. You cannot escape by simply not investing directly. So what should you do here is my advice. First, understand your actual exposure. If you have a pension, find out how much is invested in private equity. If you have investments in target date funds or balance funds, check whether they have alternative investment exposure. Knowledge is the first step to protection. Second, increase your allocation to liquid assets, cash, treasury bonds, publicly traded stocks, assets you can sell when you need to. If private equity implodes, liquidity will become extremely valuable. People with cash will be able to buy assets at distressed prices. People without cash will be forced sellers at the worst possible time. Third, reduce leverage in your own life. Pay down debt, especially variable rate debt. If the financial system goes through another crisis, credit will tighten. Interest rates on existing debt could spike. Being debt-free gives you enormous flexibility and security. Fourth, be very cautious about any investment product that promises private equity-like returns. There has been a proliferation of retail products trying to give ordinary investors access to private equity. Business development companies, private credit funds, interval funds, many of these are leveraged bets on the same underlying assets that are going to get crushed. The fees are high and the risks are poorly disclosed. Fifth, prepare mentally for volatility. When this bubble pops, markets will overreact. There will be fear and panic. Prices will fall below fair value. If you are prepared mentally, you can be a buyer when everyone else is selling. If you are not prepared, you will panic with the crowd and lock in losses at the bottom. Let me share something that keeps me up at night. The private equity industry has spent the last decade telling a story about how they are sophisticated investors who can generate superior returns through operational improvement and financial engineering. Pensions and endowments have bought this story completely. They have shifted trillions of dollars from public markets to private equity based on the promise of higher returns with lower volatility. But the lower volatility was an illusion created by not marking investments to market. And the higher returns were largely a function of leverage and financial engineering that works until it does not. When the real values are revealed, when the debt comes due, when the defaults cascade through the system, there is going to be a massive loss of confidence. Investors who thought they were being sophisticated will realize they were sold a bill of goods. There will be lawsuits, there will be regulatory investigations, there will be political consequences, but by then the damage will be done, the money will be lost, the pensions will be underfunded, the workers will be laid off, the communities will be devastated. I am not trying to be alarmist for the sake of attention. I am telling you what I genuinely see based on decades of experience watching financial markets. The conditions that create crises are present. The warning signs are flashing. The only question is timing. Could I be wrong, Of course, markets have a way of confounding predictions. Maybe interest rates come back down and the debt wall becomes manageable. Maybe the economy stays strong and portfolio companies grow into their valuations. Maybe institutional investors stay patient and the liquidity crisis resolves. But I would not bet on it, and I would not bet my retirement on it. The risks are too high, and the downside is too severe. The prudent course is to prepare for the worst while hoping for the best. Reduce exposure where possible, increase liquidity, avoid leverage, stay alert. There is an old saying on Wall Street: markets take the stairs up and the elevator down. The private equity market took the stairs up for 15 years. When it takes the elevator down, it is going to happen fast. Faster than most people can react. The time to prepare is now, not when the headlines are screaming about private equity defaults, not when your pension fund announces it is cutting benefits, not when the bank that holds your mortgage gets into trouble. Now, I hope I am wrong about all of this. I hope private equity navigates the debt wall successfully. I hope valuations gradually normalize without a crisis. I hope the millions of people whose retirements depend on private equity returns are protected. But hope is not a strategy. And in my experience, when the warning signs are this clear and this numerous, the crisis usually comes. Maybe not exactly when or how you expect, but it comes. Be ready. The history of financial markets is littered with episodes where smart people convinced themselves that traditional rules no longer applied, that this time was different, that new financial innovations had eliminated old risks. Every single time, they were wrong. Every single time, the old rules reasserted themselves, often violently. Private equity is not immune to these rules. Leverage still magnifies losses. Valuations still matter. Liquidity still matters. When you pay too much for assets with borrowed money and cannot exit when you need to, bad things happen. This fundamental truth has not been repealed. I have shared what I know and what I see. The rest is up to you. But please, do not say you were not warned. The cracks are already forming. The bubble is already starting to break. What happens next depends on choices you make today. Choose wisely. Your financial future may depend on it. Let me go deeper on something that I think is critically important: the mechanics of how this crisis will unfold. When a private equity-backed company cannot refinance its debt, it does not just quietly disappear. There is a cascade of consequences that ripples outward first. The company defaults on its loans. This triggers the lenders to take control. But here is the thing: the lenders often do not want these companies. Banks are not in the business of running retail chains or manufacturing plants or healthcare services. They want their money back, not an operating business. So the lenders try to sell. They hire investment banks. They run a process. But who is going to buy an over-leveraged company in a distressed market? Other private equity firms are facing the same problems. Strategic buyers have their own challenges. The buyer pool has shrunk dramatically. The result is either a fire sale at a fraction of the debt value, which crystallizes massive losses for the lenders, or a prolonged bankruptcy process that destroys value through legal fees and operational disruption. Neither outcome is good for anyone involved. Now multiply this by hundreds or thousands of companies facing the same situation simultaneously. The distressed debt market cannot absorb this volume. The restructuring professionals cannot handle this many cases. The system gets overwhelmed. I have studied every major financial crisis of the past century. They all share a common characteristic. At some point, the volume of problems exceeds the capacity of the system to process them. That is when panic sets in. That is when rational analysis gives way to fear. That is when prices overshoot to the downside. We are heading toward that kind of moment in private equity. The infrastructure to handle a wave of defaults simply does not exist at the scale that may be required. Let me talk about another dimension of this crisis that most people are not considering. The talent exodus from private equity. For the past 2 decades, private equity has attracted the best and brightest from business schools and investment banks. The compensation was extraordinary. A successful private equity partner could make tens of millions of dollars per year. Even mid-level professionals earned salaries that dwarfed what they could make elsewhere. This compensation was funded by the 2 and 20 fee model. 2% annual management fees on committed capital plus 20% of profits above a hurdle rate. When funds were growing and returns were strong, this model generated enormous wealth for private equity professionals. But the model is breaking down. Investors are pushing back on fees. Fundraising is declining. Returns are under pressure. The math that made private equity so lucrative is changing. I am already seeing talented people leave the industry. Some are going to positions at family offices or pension funds. Some are starting their own firms focused on different strategies. Some are leaving finance entirely. This talent drain is both a symptom of the crisis and a cause of accelerating problems. When the best people leave, the quality of decision making deteriorates, mistakes multiply, the downward spiral intensifies. The private equity industry was built on the premise that smart people with aligned incentives could create value through better management of companies. Take out the smart people, misalign the incentives through a broken fee model, and what is left? A highly leveraged bet on the market with a bloated cost structure. I want to spend some time on the pension crisis dimension because I think it is underappreciated. Public pension funds in America are responsible for the retirement security of roughly 20 million current and former government workers, teachers, firefighters, police officers, sanitation workers. These are people who spent their careers in public service with the promise that their retirement was secure. Many of these pension funds are already significantly underfunded. They have made promises they cannot keep based on current assets and realistic return assumptions. To close this gap, they have taken on more and more risk, including massive allocations to private equity. The theory was that private equity would generate higher returns than public markets, helping close the funding gap for a while. It seemed to work. Reported returns from private equity were consistently higher than public market benchmarks. But those returns were largely an illusion. They were inflated by leverage that magnifies gains in up markets. They were smoothed by the mark-to-model accounting I described earlier, and they were cherry-picked through comparison to public market benchmarks that did not reflect the actual risk being taken. Now the chickens are coming home to roost. Private equity returns are going to disappoint, probably severely. Pension funds that counted on 8, 10, 12% returns from private equity are going to get far less, maybe zero, maybe negative. This will blow massive holes in pension fund projections. Plans that thought they were 80% funded might actually be 50 or 60% funded when realistic private equity values are recognized. The unfunded liabilities will explode. What happens then? There are only a few options. Governments can dramatically increase contributions, which means higher taxes or cuts to other services. They can reduce benefits for current and future retirees. They can try to stretch out the problem through actuarial gimmicks that just delay the day of reckoning. Or some combination of all three. None of these options are politically palatable, but they may be unavoidable. And the people who will bear the consequences are the workers who were promised secure retirements and the taxpayers who will be asked to fill the gap. This is not some abstract financial problem. This is going to affect real people in real communities across America. Teachers who cannot afford to retire. Police officers who have to work into their 70s. cities that have to cut services to fund pension contributions. The private equity bubble is not just a Wall Street problem, it is a Main Street problem. And when it bursts, Main Street is going to feel the pain. Let me address the counter-arguments I hear from private equity defenders. Some say that private equity is different from other financial bubbles because the underlying assets are real businesses with real cash flows. Unlike dot-com stocks or subprime mortgages, there is something tangible there. This is true but irrelevant. Real estate in 2007 was also real, tangible assets. The problem was not that the houses did not exist. The problem was that they were dramatically overvalued and financed with too much debt. The same is true of private equity portfolio companies today. Some say that private equity firms are sophisticated operators who can create value through operational improvements. Even if they overpaid, they can grow into the valuations. This is the argument that has been used to justify every bubble in history. Prices always reflect future growth. But at some point, the growth required to justify current prices becomes implausible. We are well past that point in private equity. Some say that interest rates will come back down, solving the refinancing problem. Maybe, but even if the Federal Reserve cuts rates, they are not going back to zero. The era of free money is over. The debt burden facing private equity portfolio companies is going to be permanently higher than the past decade. Many companies that were viable at 2% rates are not viable at 4% rates, let alone 6%. Some say that the private equity industry has been through difficult periods before and always emerged stronger. This is true. Private equity survived the savings and loan crisis, the dot-com bust, the 2008 financial crisis. But each of those periods saw a significant shakeout. Weak firms failed. Overextended portfolios were liquidated at losses. The industry consolidated. That is exactly what I expect to happen again. Some private equity firms will survive and even thrive. They will pick up distressed assets at cheap prices and generate strong returns on the other side. But many firms will not survive, and many investors, including pension funds and endowments, will suffer permanent losses. The question is not whether there will be a reckoning. The question is how severe it will be and how long it will last. Based on what I see, I believe this will be severe. The leverage is too high. The valuations are too stretched. The debt maturities are too concentrated. The illiquidity is too extreme. All the conditions are in place for a very painful adjustment. I want to close with some thoughts on what this means for the broader economy. Private equity has become deeply embedded in the American economy. Private equity-backed companies account for roughly 5% of GDP. They employ 11 million workers. They touch virtually every industry from healthcare to retail to manufacturing to technology. When private equity sneezes, the economy catches a cold. When private equity gets pneumonia, the economy could end up in intensive care. I am not predicting another 2008. The banking system is better capitalized today. The regulatory framework is stronger. The Fed has more tools to respond to crisis. But I am predicting significant economic disruption, job losses in private equity-backed companies, pullback in investment spending, tightening of credit conditions as banks deal with loan losses, reduction in tax revenues as profits disappear. This could easily tip an already slowing economy into recession, or it could turn a mild recession into something worse. The private equity crisis will not happen in isolation. It will interact with other economic challenges, rising interest rates, slowing consumer spending, geopolitical uncertainty, to create a potentially toxic combination. The time for policymakers to address this was 5 years ago, when the bubble was still inflating. They could have raised capital requirements. They could have limited leverage. They could have required more transparent valuations. They chose not to. Now the choices are more limited. and the outcomes are more painful. We can let the crisis unfold and deal with the consequences, or we can try to engineer a soft landing through various interventions. But there are no good options, only less bad options for individuals. The message is clear: prepare for turbulence, build resilience in your financial life. Do not assume that the good times will continue indefinitely. They never do. I have seen this movie before. I know how it ends. The only uncertainty is the timing and the exact plot points along the way. But the ending is clear. Bubbles pop. Leverage kills. Reality wins. Protect yourself accordingly. There is one final point I want to make, and it concerns the psychology of financial crises. When bubbles are inflating, warnings fall on deaf ears. People do not want to hear that their investments are overvalued. They do not want to hear that the returns they have been enjoying are unsustainable. They attack the messenger rather than consider the message. I experienced this in 2007 when I warned about housing. I was called a pessimist, a perma-bear, someone who did not understand the new paradigm. The attacks were personal and persistent, right up until the moment when everything I warned about came true. I expect the same pattern now. Private equity insiders will dismiss these warnings. They will point to the industry's track record. They will cite sophisticated analysis showing why this time is different. They will attack my motives and my understanding. But the math does not lie. Leverage amplifies losses. Illiquidity prevents escape. Overvaluation eventually corrects. These are not opinions. These are iron laws of finance that have held true across centuries and across every asset class. The institutional investors who are over-allocated to private equity know this deep down. I have spoken with many of them privately. They understand the risks, but they are trapped by their own past decisions and their incentive structures. Admitting the problem means admitting mistakes. It means explaining to boards and beneficiaries why they were so wrong. It is easier to hope the problem goes away than to confront it directly. This is human nature. It is understandable, but it does not change the outcome. It just delays the reckoning and potentially makes it worse. My advice to ordinary people is simple. Do not wait for the institutions to act. Do not wait for official warnings. Do not wait for the headlines to confirm what the data already shows. By then it will be too late to protect yourself. Act now while you still can. Reduce risk, increase liquidity, build resilience. Question the assumptions underlying your retirement projections. Think about what happens if private equity returns disappoint. The people who emerge from financial crises in the best shape are not the ones who were the smartest or the best informed. They are the ones who were the most prepared. The ones who had cash when others needed cash. The ones who had flexibility when others were trapped. You can be one of those people, but only if you start preparing now. The private equity bubble is cracking. The cracks will spread. Eventually, the whole structure will give way. Position yourself on solid ground before that happens. Your future self will thank you for the prudence you show today.